Welcome to the Deep Dive. We're here to sift through complex information and pull out the key takeaways for you.
That's the goal. Get you the insights you need, fast.
Today, we're tackling Deutsche Bank's 2024 annual report. That's the Form 20F. It's their big yearly update for investors and, well, anyone interested.
It really is packed with detail.
And our mission is simple. Give you, the learner, a clear view of their business, their performance, their strategy, basically how Deutsche Bank works and where it's headed.
Right. Without getting totally bogged down in jargon, these reports cover everything. Business segments, financials, risks, outlook.
Exactly. So we'll use the report's info as our guide today. Let's start with the structure. How is the bank actually organized?
Okay, so the management board, they're the key decision makers. They look at four main business segments to figure out performance and where to put resources.
And those are?
You've got the corporate bank, the private bank, the investment bank, and then asset management, which most people know as DWS.
Got it. 4 pillars. Let's maybe start with the corporate bank. What's their focus?
Well, they have a huge global network, something like 140 countries. That scale, combined with local know-how and a really wide range of products, is a major advantage for them.
Especially for big international companies, I imagine.
Precisely. It allows them to handle complex stuff that maybe smaller banks just can't. Builds sticky relationships, generates fees.
The report also mentions them being a transition partner. What does that actually mean in practice?
It's about sustainability. They're actively providing green finance solutions, think funding for renewable energy, green bonds, that sort of thing.
So helping clients move towards more sustainable operations.
Exactly. It taps into a growing market and supports their clients' own environmental targets. It's strategic.
And within the corporate bank, any specific initiatives they highlighted?
Yeah, they mentioned a focus on advisory and risk management solutions. It's about getting different teams, like capital markets and treasury specialists, to work closer together.
So a company gets more joined-up advice.
That's the idea. Raise capital and manage the risk, all streamlined. Better for the client, more business for the bank through, cross-selling.
Okay, makes sense. Let's pivot to the private bank. Who are they serving?
This is more about individuals, personal clients, entrepreneurs, wealthy families, especially the very wealthy. They also handle commercial clients in some specific international markets.
More personal then.
Definitely. And they're making moves there.
Yeah.
Like in early 2024, they set up a dedicated team just for ultra high net worth clients in Germany.
Focusing on the top end.
Yes. And they're also trying out remote advisory, plus opening new, more modern private banking centers in Germany, trying to blend digital and physical service.
Interesting. What about this one bank collaboration idea? Is that actually working?
It seems to be. They're pushing for the private bank and corporate bank to cooperate more.
So, like, referring clients back and forth?
If a private bank client's business needs corporate bank services or vice versa, they say it's leading to successful referrals and bringing in new assets. They're also really targeting those ultra-wealthy clients and family offices internationally.
Right. Okay, now the investment bank. Often seen as maybe more volatile. What's the outlook there?
Well, the report suggests they expect fixed income and currencies FIC revenues to stay strong. Client activity and market volatility are key drivers there.
Volatility can be good for trading, I suppose.
It can, yeah. Their credit trading did particularly well. But, volatility cuts both ways, carries risk too.
True. Was it just driving the investment bank?
No, not entirely.
Yeah.
Their FIC financing revenues were up too. That was helped by higher net interest income, basically earning more on loans than paying on deposits, and also higher fees from arranging financing.
And other parts.
A really notable point was the big jump in origination and advisory revenues. That's helping companies issue shares or bonds and advising on M&A.
And why was that up so much?
They put it down to gaining market share and just the overall industry fee pool getting bigger. Seems like they're winning more deals.
And strategy-wise, where are they focusing in the investment bank?
They mentioned growing specific areas like platform businesses and also their European alternatives credit platform that's more non-traditional lending.
Okay. That leaves asset management, DWS. What's their strategy?
They call it the value strategy. The main aims are keeping their lead in mature markets for active equity and fixed income.
Active meaning managers trying to beat the market.
Right. And also scaling up their multi-asset solutions funds that invest across different asset classes. They also plan some selective expansion in their equity platform.
And with interest rates higher now.
Yeah, that means a continued strong focus on fixed income and serving institutional clients, like pension funds, who rely heavily on bonds. Plus, enhancing those multi-asset offerings for diversification.
Did the report show where the money was actually flowing in DWS during 2024?
It did give a breakdown. There were actually net outflows from active equity, active fixed income, and active multi-asset.
So money leaving those actively managed funds.
Yeah. But on the other hand, they saw net inflows into things like active SQI. That's their quantitative, algorithm-driven stuff, active cash, passive funds like index trackers, and alternatives.
So a bit of a shift in what investors wanted during that period.
Seems like it, yeah. A mixed picture overall for flows.
Now, underpinning all these businesses, there's a big push on efficiency,
Oh,
right?
absolutely. There's a major $2.5 billion operational efficiency program running through 2024.
What does that involve?
Quite a few things. Optimizing tech platforms in Germany, workforce reductions, especially in non-client roles, improving IT infrastructure, and more automation for routine stuff.
And the goal is cost savings.
Primarily, yes. They expect most of these actions will help lower their adjusted cost run rate starting in 2025.
So lower running costs going forward.
That's the plan. They also think non-operating costs, things like big legal charges, restructuring should come down in 2025, back towards more normal levels.
And does this feed into any specific targets?
Yes. They've set a new target for their cost-income ratio that's cost as a percentage of revenue, aiming for about 64% in 2025. Lower is generally better.
Okay. Now, no business operates without risks. What are the main challenges Deutsche Bank flags?
Well, there are several key ones. A big one is simply not hitting their 2025 targets.
Because of?
Could be a worsening economy, loss of market confidence, clients changing behavior. Any of those could hit profits or even cause losses.
Standard banking risks, I suppose. What else?
The legal and regulatory environment is always a factor. New rules might force business changes, require more capital, demand more liquidity. It's constant.
And market exposure.
Definitely. They're heavily exposed to financial markets, so big downturns or prolonged volatility can really hurt revenues and profits.
You mentioned regulation. Anything specific on the horizon?
They mention ongoing consultations, like from the European Banking Authority on things like how banks value assets or handle off-balance sheet items. These could lead to higher capital requirements, specifically CET1 capital.
CET1 being that core measure of strength.
Exactly. And then there's the continued regulatory focus on things like anti-money laundering, AML, and know your customer KYC processes.
Always in the headlines.
Right. Failing to meet deadlines for improving controls, there is a big risk reputationally and financially.
What about competition?
Yeah.
Technology.
Yes, they acknowledge the threat from digital innovation. They need to keep investing heavily in their own digital offerings.
Makes sense. Any other risks jumping out?
Well, there's the potential fallout from any past or ongoing legal cases.
Yeah.
Settlements, fines, they can be costly and force business changes. Tax complexity is another one, plus ongoing tax audits.
Yeah.
They even mention navigating the rise of anti-ESG measures in some places, which adds another layer of complexity. And reliance on third-party suppliers and the judgment involved in valuing certain complex financial instruments. If assumptions change, losses can follow.
A lot to manage. So with all that as background, let's look at the numbers for 2024. How did revenues land?
Net revenues came in around $28.9 billion.
And how did that compare to their target?
It was a bit under their goal, which was about $30 billion for 2024.
But any positive trends?
They do point out a compound annual growth rate of 7.2% since 2021. So the longer-term picture is growth. And looking ahead, they're targeting roughly $32 billion for 2025 revenue.
Okay, and profitability in 2024?
Profit before tax was $5.7 billion. Net income attributable to the shareholders was $4.2 billion.
What drove the revenues they did get?
A few key things. Higher interest rates definitely helped boost net interest income, especially in the corporate and private banks.
We heard about that earlier.
Right. And the investment bank had a strong showing, particularly FI, thanks to client activity and that market volatility. Plus, the gains in market share for origination and advisory were important.
Got it. And on the flip side, expenses. What drove those?
Total non-interest expenses were $23.0 billion, up 6% from the year before.
Why the increase?
A big driver was higher general and administrative costs. That was mainly due to increased litigation charges, specifically mentioning the Postbank takeover and issues with Polish FX mortgages, and also a write-down related to Russian alliance.
So specific legal and one-off items pushed costs up.
Yes, though it was partly offset by lower bank levies and lower spending on professional fees.
Let's talk credit losses, always crucial for a bank. What did the report say?
It didn't give one single group provision figure for 2024 in the excerpts we saw, But it did mention the corporate bank's 2023 provision was $549 million, which was up quite a bit year on year.
Okay, but what about the overall picture?
As of the end of 2024, their total allowance for credit losses, the pot set aside for potential defaults, was about $6.2 billion.
How do they calculate that?
They use models to estimate expected credit losses, or ECL. These factor in things like the probability of default, PD, loss given default, LGD, and exposure at default, EAD.
Complex models.
Very. And importantly, the report highlights how sensitive these ECL numbers are to economic changes, GDP, unemployment, property prices, credit spreads. They even show potential impacts if these factors move up or down.
Right, so the economic outlook really matters for potential losses. Let's shift to the balance sheet. Any big changes end of 2024 versus 2023?
A few things. Cash and balances with central banks were down, but financial assets measured at fair value were up, driven by activity across the segments.
Okay, what else?
Financial liabilities at fair value also rose, mostly due to new long-term debt issued by the investment bank's FIC division. Long-term debt at amortized cost actually fell, mainly because they repaid some ECB funding, the TLTRO funds.
And the crucial capital part, equity?
That was a positive.
Yeah.
Common Equity Tier 1 capital, the CET1, increased to $49.5 billion, up from $48.1 billion the year before.
Strengthening the core capital base.
Exactly. They also mentioned movements in risk-weighted assets, RWA, and the leverage ratio, but the focus is often on that CET1 number.
So how does that CET1 stack up against requirements?
Banks face minimum capital rules under regulations like CRR, covering credit, market, and operational risks. On top of that, the ECB sets a specific Pillar 2 requirement for Deutsche Bank,
Which was?
2.65% of RWA as of the start of 2024. Their actual CET1 ratio at the end of 2024 was 13.4%.
And how does that compare to the minimum needed?
Well, above the trigger point, the MDA trigger, where restrictions on dividends or bonuses could kick in. So a healthy buffer.
The report also mentioned TLAC and MREL. What are those quickly?
They're about ensuring the bank has enough resources beyond just equity to absorb losses if it gets into serious trouble, allowing for an orderly resolution without taxpayer bailouts. TLAC is total loss absorbing capacity. MREL is minimum requirement for own funds and eligible liabilities.
So buffers for really bad scenarios.
Right.
And liquidity.
They monitor key ratios there too. The liquidity coverage ratio, or LCR, checks they have enough high-quality liquid assets for short-term needs. And the net stable funding ratio, NSFR, looks at the stability of their funding over a longer one-year horizon.
Okay, so capital and liquidity look okay based on the report. Finally, how are they planning to return value to shareholders? Dividends and buybacks.
Yes. The policy is generally an annual dividend approved at the AGM, paid shortly after.
And buybacks.
They completed $0.7 billion in share buybacks during 2024, and the AGM authorized them to do more, specifically to return capital. Between the 2024 AGM and year-end, they bought back another 20.9 million shares for cancellation.
So actively reducing the share count and returning cash.
That's the aim. They held nearly 50 million treasury shares from buybacks at the end of 2024.
Okay, so bring this all together. What's the overall picture moving forward based on this 20F?
Well, it seems like they're forecasting continued revenue growth in 2025 across the board, aiming for that $32 billion mark. Efficiency is a huge focus with that 64% cost-income ratio target.
And the strategy.
Sticking to their core businesses, driving those efficiency savings home, and just navigating that complex regulatory and economic world.
While keeping an eye on the risks.
Absolutely. Macro conditions, market swings, regulation, competition, legal stuff, those remain key things to watch. But their capital and liquidity seem robust, exceeding the requirements.
And shareholder returns are still on the agenda.
Yes, the plans for dividends and buybacks signal that commitment, although it's always subject to AGM approval and market conditions, of course.
So it paints a picture of a bank focused on controlled growth, serious efficiency efforts, and rewarding shareholders, all while managing a pretty complex operating environment.
I think that sums it up well. This report gives a really detailed snapshot of where they stand and what they're aiming for.
Okay, so here's something for you, the learner, to think about. Considering everything we've discussed, the global economy, the regulations, their own targets, how sustainable do you think Deutsche Bank's planned growth and efficiency gains really are? What might be the biggest curveballs or maybe the hidden opportunities for them in the next few years?
That's a great question. Hopefully this deep dive gives you a solid base to form your own view.
Absolutely. Remember, digging into these reports yourself and getting different perspectives always leads to a richer understanding. Thanks for joining us on The Deep Dive.